Good morning, shareholders. I think in the interests of good Zoom etiquette, we should get started. Thank you, everyone, for dialing in. If our panelists could turn on their videos, please. There we go. Good morning, shareholders, and thanks for dialing in. This is the Antipodes Global Investment Company full year 2020 results presentation. We will refer quite a bit today to the company as APL by its ASX ticker for short. My name is Chris Mayer. I'm the Director of Listed Funds at Pinnacle Investment Management. Pinnacle is a equity shareholder in Antipodes Partners, the manager of the APL portfolio. Pinnacle handles all the shareholder relations on behalf of the company, and I will be your host today. Joining us today is Chairman Jonathan Trollope. Jonathan, if you want to just wave your hand. Jonathan's wearing the tie. Also joined by Company Director Andrew Finlay. You can see Andrew in the middle. And also Jacob Mitchell, Chief Investment Officer and founder of Antipodes Partner, the portfolio manager of the company's portfolio. Jacob, if you just raise your hand there. There we go. Okay. With that introduction, the presentation slides will be shown on screen. You should be able to see them. If you are not on video, but you're dialing in, you can also find the presentation slides on the ASX under the APL ticker or on the company's website. And you can follow along. Our presenters will refer to each slide as we go along. At the end of the session, we'll host a short question and answer session. If you do want to ask a question, please click the Q&A little button there on the Zoom box, and you can type in your question and we will endeavor to get to it at the end. So with that, I'll hand over now to Jonathan, who will kick us off with the presentation. Jonathan, if you don't mind, please just referring to the slides that you are on so that those listening in can follow in. Jonathan, over to you.
Sure. Thank you, and a very warm welcome to all shareholders who are participating in this virtual forum. I think we should also say thank you to Zoom, and thank you, Chris, to you and your team and Amelia for organizing this webinar today. Chris, if you can just move on to the agenda, which I'll just run through very briefly, which is slide 3 on the slide pack, which is there. Yeah, we'll take the disclaimer as read. Firstly, I will deal with the company results, which will be the NTA performance of the company in the last 12 months. And I also thought it relevant to give shareholders a perspective of the longer term view. So I'll also deal with the NTA since the company listed in October 2019. And I'll then go through the dividend history of the company and move on to the initiatives that we've instituted over time to seek to narrow the discount between the share price and the NTA of the company, and most relevantly, the recently announced conditional tender offer, or CTO. After that, Jacob Mitchell will, who's, as Chris has mentioned, is the Chief Investment Officer of the manager Antipodes Partners Limited, will deal with the portfolio and the market update. And after that, Jacob, myself, and Andrew Finlay, who's been introduced to as CEO of the manager and also on the APL board, will be available to answer questions you may have. So Chris, if you could move to slide 4, please. Thank you very much. So hopefully you're all seeing that on your screen, and that shows the financial results for the year from 1 July 2019 to 30 June 2020. If you start on the left-hand side of that graph, you will see that the opening NTA was $1.14, $1.14.4 to be precise. During the last 12 months, the main detractors which have led to reduction in NTA have been the dividends paid, and that's about the 5th bar along of 4.5 cents, and the portfolio performance, which detracted just under 4 cents per share, that's 3.9 cents. The tax paid was very little, 1/10 of 1 cent. The company expenses similarly were very light, 2/10 of 1 cent. The buyback which was in place in financial year 2020, was accretive to the NTA by 2.1 cents. So if you do the arithmetic across that graph, you arrive at the closing NTA at 30 June 2020 of just under $1.08, $1.07.8. And the current NTA is just over $1.10. If we could move to the next slide, please, which is slide 5 on the pack. And that, I think it is relevant for shareholders to have a long-term view of the history of the company since it was established and listed in October 2016. The opening NTA was the subscription price, which is $1.10. You can see that on the bottom left side, less the issue costs, which were 3.3 cents per share. During the 3.5, getting on for 4 years that the company's been in existence, the portfolio performance has added 28 cents to the NTA, and that's a pretty commendable performance, I do consider. The tax paid over the period is just over 5 cents. The company expenses for the 3.5 years plus have been under 1 cent in total. That's 7/10 of 1 cent, and that's a reflection largely of the scale of the company. We're at a sufficient scale that the management expense ratio is pretty low because we can spread our fixed costs across a lot of capital. The dividends paid during the 3.5 years of the company's existence have been 11.5 cents. That excludes the dividend we're going to pay at the end of September. I'll deal with the dividends next. And the effect of the option dilution, mitigated somewhat by the buyback accretion, detracted just over 9 cents. That's 9.4 cents from the NTA. So again, you do the arithmetic across the page, and that explains how we get to the NTA at 30 June 2020 of $1.07. So Chris, if we could move to the next slide, please, which is the dividend history of the company. As the graph shows, we paid our first dividend in the second half of 2018. That reflected approximately 20 months of performance, and the maiden dividend was 5 cents. In FY 2019, the company paid an interim dividend of 2 cents and a final dividend of 2.5 cents, making a total dividend for the year of 4.5 cents. And similarly, in 2020, we paid an interim dividend of 2 cents, and the company will be paying a final dividend of 2.5 cents on 30 September 2020. It's relevant, I think, just to comment that the dividends have been franked as to 50%. We would obviously love to pay dividends that are fully franked, but the reality is that a global LIC, we do not receive franking credits from the share investments we make, which distinguishes us, I guess, from an Australian LIC, which will invest in Australian companies and receive Australian dividends with franking credits. And therefore, we're relying on the tax which the company pays to generate the franking credit account, which enables us to pay franked dividends. If one looks at it on a yield basis, at the current share price of about 92 cents, that's a dividend yield of 4.9%. And if you gross up the yield for the 50% franking, that shows a yield of 5.9%, which we do believe is attractive and a strong level of income for a global equity portfolio. If we can move to the next slide, and this is the initiatives to close the discount to NTA. Obviously, the discount to NTA in the last 18 plus months has been if not the major focus of the board. And we've initiated various steps to address this, and we've kept the shareholders informed of this as we've gone along the way. Looking at that slide, the various initiatives include shareholder alignment. The manager, Antipodes, is now one of the major shareholders in the company. It's in the top 10, and it shows its support of the company. We have, together with Pinnacle as distribution manager and the manager, sought to increase communications with shareholders, and we're very focused on that. We are also focused on transparency of the portfolio performance, and for some time now, shareholders have had the benefit of NTA being published on a daily basis, and we do believe that that is one of the few LICs in the ASX context which publishes NTA. Measures have been taken to galvanize and retain support in the market. It is one of the 10 most liquid LICs. APL has a highly recommended status from Zenith, and we have coverage in the market from brokers Bell Potter, EL&C Baillieu, and Taylor Collison. In terms of capital initiative, over the last year, the major initiative has been the buyback of shares. Shareholders who follow the company closely will be aware that in April we obtained approval from shareholders to increase the buyback above the normal 10% limit allowed without shareholder approval. So we have shareholder approval to buy back up to 100 million, which is about 20% of the company's share capital. And as at 31 August, we had bought back 13.5% of the company's share price at a discount slightly in excess of 14%. And buying the discount obviously was one of the reasons that it was accretive to the NTA for the financial year 2020. We have just under 40 million shares left under the existing buyback authority, and we will be using that opportunistically as we think circumstances dictate. If we could move to the next slide. The most major capital initiative we've recently announced is the conditional tender offer. This was announced to the market with the annual report after we undertook extensive investigations of what LICs were doing, not only here, but more relevantly on the global stage. And in particular, the conditional tender offer is a mechanism which has been used very successfully in the UK market. And we are confident as a board and as a company that over time, this initiative will materially narrow the discount which we currently have to NTA. So if I could just deal with the key aspects of what the conditional tender offer involves. The key elements are at the 5-year date, which is October 2021 of the listing. If the company's share price for the previous 12 months on a daily average basis has exceeded a 7.5% discount to the NTA, then the company will tender to shareholders to offer shareholders the ability to sell their shares, and the company will buy back 25% of its share capital. Shareholders will be able to tender as many shares as they like, and if each shareholder were to tender 25% or more, then 25% of their shares would be bought back. If shareholders tendered more than 25%, but other shareholders tendered less than 25%, or indeed none of their shares, then the allocation among shareholders who tender more than 25% will be determined on a pro rata basis, looking at the amount of shareholders who tender more than 25% and those who tender less than or no shares at all. We will be seeking shareholder approval for this at the AGM to be held at the end of November 2020, and we do intend this to be a regular program and to have this on similar terms every 3 years after the initial conditional tender offer. There'll be more detail on this in the notice of meeting that will be sent out with the AGM notice. There'll be an information booklet which will explain more details of the specific terms and conditions associated with that. So that concludes, from my perspective, the overview of the company results and NTA discounts initiatives, and I'll now hand over to Jacob to go through the portfolio and market update. Thanks very much.
Thank you, Jonathan, and welcome to our shareholders today. I'm going to just present on 6 slides, starting on slide 10, which really just provides a backdrop on what we see, the market environment that we've been operating in for a significant portion of the LIC's life. So it's been a market that's progressively become more concentrated in terms of the outperformance of a select number of winners. It's the large, let's call them internet platform companies. And you can see there on the yellow line, if we turn to slide 10, you'll see there on the yellow line that there is, the market cap concentration in these large leaders has just become more and more extreme. And on the flip side, the breadth, which is just a measure of the percentage of companies in the market that are actually outperforming the benchmark. In a healthy market, typically breadth is operating at around about 50% on average, as you would expect. The breadth in the market has dropped to very, very low levels. So the breadth is measured there on the left-hand axis. So it's roughly a third of stocks at the moment. Now, at the same time, the traditional value part of the market, let's call it, thinking about value is just the performance of low multiple stocks versus high multiple stocks. Value typically goes through different cycles. Often value outperformance is associated with a cyclical rebound in the economy or some fundamental change in the narrative. You can see there, if you go back to the year 2000, a significant outperformance of lower multiple stocks following the bursting of the dot-com bubble. And that was associated with the beginning of the commodities super cycle. So there's 2 ways I think that value outperforms: cyclical rebound or a more structural change in the investment composition of the underlying economy. So value has underperformed now for most of the period that the LIC has been in existence. So now what can change? Let's say what can change this environment. If you turn to slide 11, we've had a rebound since we've had these significant monetary and fiscal stimulus announced around the world in April. A very large rebound in the market, but once again led by the secular winners. A lot of the trends that were in place in 2019 have simply been reinforced by the impact of the pandemic. So one question which is pertinent is, even if politicians open economies, we really need a pathway to a vaccine to ultimately normalize consumer behavior. And it's very topical given the news overnight that AstraZeneca is potentially putting its phase 3 trials on halt due to an adverse outcome. In our view, AstraZeneca was probably the weakest of all the candidates, so it's not a significant surprise. But we do see the first generation of vaccines really by the end of December, let's call it the December quarter, we will start to see the phase 3 data relating to those vaccines. And we think, given the science, the nature of the virus, and based on our own research and understanding, we think the chances of success are there. Now, the second generation are probably the vaccines that we're most likely to take in terms of their being let's call it more longer term, more resilient. They're not likely to start to become available until mid next year. But we do think there is a constructive pathway ultimately to a vaccine that is suitable for mass adoption by the end of 2021. So we think we're on that pathway, and the other point to note is that even with the spike in infections in various parts of the world, there hasn't been a a correlated spike in hospitalizations or in fatalities. So the medical systems globally are starting to cope better with outbreaks of the virus. So we are going to muddle our way ultimately, we think, through 2021 to a fully opened economy, and one where consumers ultimately have confidence to go back, to go to cinemas, to go to the mall, to ultimately do more travel. Now, we all know that not all behavior will normalize, and I'll address that as we go through, as we start to think about how we position the portfolio. Our next slide, slide 12, we really need to focus on a fundamental change in the backdrop, which is governments are now much more proactive on the fiscal lever. If you think about following the global, the financial crisis in 2008, fiscal stimulus was wound back very quickly, and monetary stimulus really defined the next decade. And the underperformance of value and outperformance of growth dominated that next decade. Now we see far more coordination. COVID has accelerated, I think, the adoption of fiscal policy as a way of addressing underlying, let's call it populism, underlying wealth differentials that have become more extreme over the past decade. And the impact of the virus has been disproportionately felt by lower income groups. And we're going to see, I think, a far more focus on, let's call it income protection, even in an opening up scenario, potentially higher tax rates as we start to pay. In the US, we have a deficit now running in excess of 20% of GDP, which is quite unprecedented. Government debt to GDP is going through 100%. And we, even when we look at Europe and some of the other countries like Canada, relatively high government debt to GDP. Southern Europe, clearly, in Northern Europe, pretty healthy. But we ultimately need to see, I think, a pathway towards investment stimulus. Income stimulus ultimately runs out. We either run out of the ability to fund it without significantly weakening currencies or causing inflation. So if we turn to our next slide, we think the framework for navigating this environment is one which looks at the portfolio or looks at the opportunity set against different stages of lockdown and recovery. The stage one, the beneficiaries of lockdown, everything to do with working from home, let's call it working from home, DIY, improving your home if you like, and that's been mainly the internet growthier parts of our portfolio that have done well. Now they are stocks that we think are still value stocks, given that their underlying longer term growth potential. They have done very well. Now the stage two, the reopening beneficiaries, this is where incrementally we are deploying capital. They are the stocks that have been hit hardest, but it's picking the winners that come out of this very tough period. Then medium term, what probably excites us the most is the clusters in the portfolio that are exposed to some of these longer term, more sustainable investment trends that are emerging around infrastructure stimulus. Now, the parts of, we think, behavior that don't normalize will be the ones associated with corporate cost cutting. We think fundamentally demand for business travel will be lower. There'll be changes in the way that corporates deploy in terms of office space. The real, I think, focus, or one of the key risks to monitor is, in this environment where unemployment is recovering, let's call it employment is recovering, but is recovering, let's call it relatively slowly. It will be just keeping an eye on house prices. What does the Fed's, the Fed's sort of intervention in the credit markets, we think it ultimately will socialize a lot of that credit risk, but the cost of that is zombification. Weaker companies are not going bankrupt. Capacity is slow to leave certain industries. So the risks to the recovery, the income stimulus that the US put in place, formally ended in July. Now, Trump is putting in place some temporary measures, but the Democrats and the Republicans are starting to find it more difficult to agree as we approach the election. Second waves obviously are impacting. Keep an eye on government debt and the ability of currency markets to stomach these relatively open-ended deficits. And then, you know, just this ongoing technology rivalry. So if we turn to the portfolio on slide 14, you can see it very clearly here where we see the parts of the portfolio that are the beneficiaries of the stage one of income stimulus and lockdown, the stage two reopening, the consumer incumbents, and some of the more cyclical parts of the portfolio that are nonetheless, I think, you know, worthy candidates, whether it's aerospace, high quality names in the aerospace or energy area, or retail banks that are getting a lot of protection from governments and are not being disrupted by fintech. And then retailers that are very much omni-channel in their approach to their consumer. In the investment buckets, we see two, let's call it two major buckets. The beneficiaries of what is currently really a European focus on decarbonisation over the next 10 years. And then other parts really around the world, the accelerated adoption related to decarbonisation of EVs, more broadly, just the accelerated adoption of 5G and ongoing cloud adoption. The final foundation to the portfolio is the tail risk protection, either via our gold and credit protection, and then shorts on weaker companies, either cyclicals that are facing secular challenges or defensives facing cyclical challenges. Turning to the performance slide 15, we really want to highlight that, yes, as a long short portfolio and a portfolio that has had an underweight on North America, slide 15, thanks, has definitely been a headwind for the portfolio in an environment also that's been fairly growth, or let's call it quite extreme in its growth orientation. Not sure why we can't. If we could get to slide 15, I can give you the numbers though, to give you a sense of how significantly the difference over the life of the portfolio. The benchmark, which is the MSCI All Countries World Index, is up 55.4% at the bottom of that middle column. Over that same period, that the equivalent value index is up 20.7%. So this has been and if you go through the history of those two indices, it's very rare that you get such a spread between the performance of the benchmark and the value benchmark. So a portfolio that had a growth tilt has potentially done much better than the benchmark. A portfolio that's had more of a value tilt has been fighting against a significant style headwind. We've also, as a portfolio, provided downside protection. It's been, we would say, the question has been, well, that's come at a cost, clearly. So it's come as a cost to upside, but it's also been, I think, the lack of upside somewhat is a reflection of an aggressive style headwind for the portfolio. So the company portfolio has outperformed the value benchmark, and it has outperformed that benchmark significantly year to date, whilst we found it tough to keep up with the broader benchmark. Looking forward, we see the backdrop is conducive ultimately for that rotation into value, out of growth, not just due to the potential for vaccines to see an accelerated opening up of the economy, but also due to a shift in the underlying investment composition of economic growth. With decarbonisation, I think a major, let's call it catalyst for a focus back on physical infrastructure and away from the current sort of Zeitgeist, which is very much focused on a select number of internet platform winners, which are probably, as we go through into next year, going to see more regulatory issues, and certainly longer term in the US, I think, a higher rate of tax as governments seek to repair balance sheets. Thank you for your patience as we've gone through the presentation, and I'll hand it back to Chris.
Great, thanks, Jacob. That's spot on timing. So I think we have 5 minutes or so left for questions. We've had a few come through already. If you do want to ask a question again, please type it into the Q&A box. I would say the most common question we've received thus far is from 3 shareholders. Mark, Eleanor, and Simon have a very similar question. I'll sort of paraphrase a little bit, but it's the CTO, or the conditional tender offer, is a step in the right direction. Why is it only starting next year and not sooner? Why the 5-year anniversary of the company as the first conditional tender offer? And maybe Jonathan, if you want to take that one.
Yeah, sure. Am I back on screen? Can you hear me? Good. It's a good question. The 5 years was chosen because we believe that that's a reasonable time to assess the performance of the company and the manager over the investment cycle. You know, Jacob's touched on the difference between value and growth. Our real hope is that by, October 2021, we're trading at NTA, and so we don't need to have these measures. But time will tell. The prospectus did say 3 to 5 years. We've had a lot of communications with some particular shareholders, and we've always said from the independent director's point of view that we're looking at the 5-year date, and that's why it's 5 years.
Maybe the other thing just to consider is because we're measuring the trigger, the condition of 7.5% discount to NTA over 12 months, we need that 12 months between when we get this approved at the AGM and a year post that as a measurement period, rather than having the measurement period backdated. So that would be the other reason. Maybe just a quick follow-up then, Jonathan, to that from Simon is, you mentioned that the conditional tender offer will happen next year for the first time, but then every 3 years thereafter. Why every 3 years? Why did you choose that time period?
It's a good question. We did deliberate and discuss it extensively, both at the board and with the manager, but we were guided mainly by the experience from the UK and their closed-end sector with the LICs. And 3 years seems to be a measure which they use, and once the program is operational, seems to have been effective in keeping that discount to the NTA within a very narrow band. So that was the main reason, based on the UK experiences. Okay,
Jonathan, then there's a question here about the impact of this conditional tender offer. So if the company shrinks by 25%, doesn't that have an impact on remaining shareholders? Because now you have costs spread over a smaller asset base. Do you want to address that?
Sure. I think there are 2 issues of that. One is the price is NTA less 2%, and the 2% is there really to take care of costs of the CTO, so that the costs of the CTO should not of themselves impact shareholders who do not elect to participate. And secondly, the company, even with a 25% reduction, is of sufficient scale. I don't have the particular numbers in front of me, but can probably do the exercise and provide them to the questionnaire, that it would still be of sufficient size that the fixed costs, which are directors' fees, ASX listing, and so on, would not be materially impacted by a reduction of 25% in the value of the funds under management. The major cost is the management fee, and that's a function of the funds under management of the company, and that is just a fixed percentage of the funds under management. So happy to maybe follow up and give an example, but I would be very surprised if the impact, even if you're not 25% of the funds under management, would be very significant at all.
Yeah, and maybe Jonathan, on the slide 5, as you pointed out, the company expenses over the life of the company have been less than 1 cent a share.
Yeah.
You can see over here, so shrinking.
So yeah, you're right, Chris. So that's 3.5 years. So even if you take that up by 25%, it's still less. Average it. It's going to be 1/10 of 1 cent a year, I would imagine, per share.
Okay, just rolling through the questions. I think this one from Anthony might be a slight misunderstanding. The question is, as a shareholder since IPO, and it relates a little bit to, could the first conditional tender offer not be earlier? But he makes the point that shareholders have not benefited, who've been in since IPO, have not benefited from the on-market buyback. I don't know, Jonathan or Andrew, if you want to clarify that that's not the case.
Andrew, would you like to do it? I'm happy to do it.
Yeah, sure. So if you just leave it on that same, the previous slide, Chris, slide 4, the yellow bar, second from the right, shows the buyback accretion. So an on-market buyback allows exiting shareholders to depart, and those remaining shareholders get the benefit of an accretion in the NTA. In our case, over the last 12 months to the end of June this year, the accretion was 2.1 cents per share. So long-term shareholders do benefit from an on-market buyback.
Okay, thank you. I'm just looking at some, thank you for your questions, by the way, everyone. They're coming through thick and fast, so I see everyone's still on the line, so we'll crack on. There's one question here, Jacob, for you, just to give the board a break, which is, in order for value to have a recovery as an investment style, do the economies need to accelerate, or do they just not need to be as bad as everyone fears?
I think that's a good question. Given where how extreme that the difference between the high P, low P stocks, not much would really need to go right. So I think it is the latter, like just less negative. Probably in terms of a timing issue though, and what we would we think is really what's more important is that the cyclical rebound that you will get once you get sort of a greater normalization in areas like leisure and travel, which are still operating significantly below potential in the West. Not so much in China. I mean, domestic air travel it's interesting that volumes, actually passengers moving around in China on domestic flights are almost flat on a year ago, which is in stark contrast to what we're experiencing here in Australia. And Europe and the US are somewhere in between. But you should see those areas where you've had significant loss of employment, if they can normalize, that triggers a cyclical rebound in some of the value areas of the market. But longer term, I think we're looking for a more structural shift in priorities let's call it from an investment perspective. And I think that changes, that is what really shifts the dial, where you see a low multiple stock, all of a sudden, maybe it's in an industrial space that's exposed to the investment that we need into the grid. As you upgrade to EVs, power demand will increase by some 40%. If you're serious about actually replacing internal combustion engines with EVs, you're talking about a super cycle in electric power. Now, at the moment, those stocks are available on, Siemens is on arguably on a very low multiple for what could be a decade of structural growth. That's where we think the biggest shift and the biggest shift to value outperforming is, and that's how we're investing. We're investing across each of the clusters, not with the hope that we get bailed out by a style shift, but with the view or the understanding that with such high PE dispersion in the market, you're going to increasingly find the genuinely idiosyncratic opportunities probably outside the very crowded part of the crowded growth winners of today.
Okay, maybe time for one or two more here, Jacob, and I'll just quickly flip to this performance slide. This is a question from Aaron, who says, if you are a value investor and you clearly show here that you have managed to outperform the value index, but not your benchmark, why do you not change your benchmark? Why is the benchmark not the value index?
That would be, I think, from our perspective, we, as a pragmatic value manager, not only do we want to outperform the value benchmark, and the, let's say we go to a period where value starts to outperform the benchmark. We don't want to. We would be disappointed if we didn't outperform both value and the benchmark. So I think it's just contextualizing our performance. Our goal is to beat the benchmark, both the global benchmark and the value benchmark. This is a long short fund, so maybe we set the bar a little high for us to beat the global benchmark in a bull market. We've always said through the cycle. Arguably, we've only had one leg of the cycle, i.e. the bull market. It'll be interesting to see if we transition to let's call it a tougher environment for the benchmark, because its growth goes through a bear market, which will weigh on the index. I think the portfolio will do, is in good shape for that type of environment.
Okay, Jonathan, and this is an interesting question from Mark, which is, I'm interested to know why you're so short-term focused in the implementation of the conditional tender offer when you are long-term investors. The fund's only been listed since November 2016. The investment style's out of favor. LICs can trade at discounts for long periods. The on-market buyback is more value accretive given the 20% discount to NTA. Why have you decided to put this conditional tender offer in place? Okay.
I think, just checking I wasn't on mute. I think it was, as I answered in the first question, Chris, look, it's a judgment call, but the prospectus made clear that the objective, and Jacob's just touched on it, was to outperform the benchmark over the investment cycle, which was typically seen as 3 to 5 years. So we do believe as a board that the 5-year period is right. People could say it should be 4 years. People could say it should be 7 years, but 5 years seems to be about a right time to evaluate the performance of the company and the manager.
Okay, and maybe the final one, Jacob, back to you from Zachary, which is, thanks for the graphs about the NTA movement, found them very helpful. Are you concerned about the difference between the Main Street economy and the Wall Street markets? Do you think the economy will catch up to the markets, or do you think the markets will move down to catch up with the economy?
I think that to answer that question is really how do you envisage the ongoing we're really talking about how next year looks, and the market, whilst you think, well, markets are at all-time high, S&P all-time high, NASDAQ until recently all-time high. That, as one of our early slides really highlighted, that's been really the outcome for 5 or 6 stocks, or let's call it broadly some of the SaaS, internet, and technology stocks more broadly. Arguably, there's already been, there's been a bear market outside of that select group of companies. So we're not really, as a stock picker, we're sort of saying, look, there may be issues. I think, yes, at the index level, you could make the case that there's been somewhat of a disconnect between what's going on broadly across the world, and as we know, central banks you've had a significant amount of easing, and that's flown into assets. And the issue is, will activity catch up? And as activity catch up, will investors' preferences change? And I would argue they almost have to, because you take a company that's been in e-commerce, it's had an injection of steroids. It gets that injection once. Now the longer term trend is still in place, but what you pay for that needs to be questioned. And I think in this environment, a lot of these winners today will be seen as growth traps because investors are simply paying the wrong multiple. And as we think next year, you might just see some of the parts of the economy that have been hit hardest by COVID start to normalize, leading to a change in preferences and the outperformance of some of the lower multiple parts of the market. But yes, I think at the index level, you are going to go into a tougher period, and and very dependent on the success of governments transitioning to investment stimulus away from what is arguably an unsustainable level of income stimulus.
All right, excellent. I think we should wrap it up there. Thank you again, shareholders, for your time and for your questions. Thank you to our panel of experts for your insights. Again, if you want the slides from today, you can find them on the company's website or on the ASX, and we will also post a replay of this presentation. Thank you again.